In the early 2000s, buying a house became very easy. Banks were lending money to almost everyone, even to people who didn't earn enough to pay the loan back. Why? Because banks believed house prices would always go up. So they thought, if the borrower can't pay, we'll just sell the house for more money later. But the banks didn't stop there. What this means is the banks bundled these risky home loans together and sold them to investors as safe products. The banks didn't keep the home loans they gave out. Imagine 100 people took home loans. Some were good borrowers, stable jobs, can pay. Risky borrowers, low income, unstable. The bank mixed all these loans together into one big bundle. Then they said to investors, this bundle pays interest every month. Most people here will pay. So this is safe. They even gave these bundles high safety ratings like AAA. So pension funds, banks, and investors around the world bought them. Why this was dangerous, the logic was, even if a few people fail to pay, most will pay. So the bundle is still safe. But there was a hidden problem. All these loans depended on one thing: house prices going up. If house prices fell, many borrowers would fail at the same time, the whole bundle would collapse together, so the risk wasn't gone. It was spread out, disguised, misunderstood. So the risk didn't disappear. It just got hidden. For a while, everything looked fine. House prices kept rising. Banks made profits, investors felt safe. Then interest rates went up. Why? Interest rates are controlled by the central bank. In the early 2000s, interest rates were very low. Borrowing was cheap, people took big loans easily. But low rates caused problems. Too much borrowing, house prices rising too fast, signs of inflation. So the central bank raised interest rates to slow things down. This is normal policy. But why did higher rates cause everything to break? Many home loans were variable rate loans. That means the payment changes when interest rates change. Imagine you buy a house. At first, the bank tells you, your monthly payment is $1,000. You can afford that, so you take the loan. But there's a catch. The loan is variable rate. That means the payment is not fixed. A few years later, interest rates rise. Now the bank says, your new monthly payment is $1,500. Nothing else in your life changed. Your salary didn't increase. Your bills stayed the same. Food and fuel still cost money. But suddenly, your housing payment is 50% higher. Why this caused mass failure? One person missing payments is manageable. But in 2008, millions of people had these loans. Many were already living paycheck to paycheck. So when rates went up, monthly payments increased. People who were already barely surviving couldn't handle it. They missed payments, defaults increased. Many homeowners could no longer pay. So houses were taken back by the banks. But now there were too many houses for sale. Prices started falling. When house prices fell, the loans behind them became worth less. Let's say a bank lends someone $300,000 to buy a house worth $300,000. At this point, loan equals $300,000. House value equals $300,000. If the borrower fails to pay, the bank can take the house, sell it, get its money back so the loan looks safe. Now imagine house prices drop. That same house is now worth $200,000, but the loan is still $300,000. This means the borrower owes more than the house is worth. Even if the bank takes the house, it cannot recover the full loan. Why the loan is now worth less? From the bank's point of view, the loan promised $300,000, but realistically, it can only recover about $200,000. So the loan is no longer worth $300,000, it's worth much less. Why this became a massive problem? This didn't happen to one loan. It happened to millions of loans at the same time. So banks suddenly owned loans that looked valuable on paper, but were backed by houses worth far less. When banks added everything up, they realized, we thought we were rich. We are not. Banks realized they were holding huge losses. Some banks ran out of money. Some collapsed. And because banks lend to each other, fear spread fast. No one trusted anyone. Credit froze. Businesses couldn't borrow. People lost jobs, spending dropped. Modern businesses run on borrowing. They borrow money to pay salaries, buy inventory, expand, survive slow months. They don't keep huge piles of cash. After the crisis, banks were scared. Banks didn't trust each other. Banks stopped lending. So even healthy businesses heard, sorry, no loans. No loan means no cash flow, no safety buffer. And a housing problem turned into a global financial crisis. Governments had to step in and save the banks because letting them fail would have collapsed the entire system. Why governments had to save the banks? Governments didn't save banks because they liked them. They did it because banks are the pipes of the economy. Banks handle salaries, savings, loans, payments between companies. If major banks failed suddenly, ATMs might stop working. People could lose access to savings, businesses couldn't pay staff, trade could freeze. That would affect everyone, not just bankers. What would have happened if banks were not saved? If governments did nothing, banks collapse, payments stop, trust disappears, economy shuts down. That's not a recession, that's a system collapse. So government stepped in to provide emergency money, guarantee deposits, calm panic, keep the system running. Saving banks felt unfair, and in many ways it was. But leaders had two choices: save the system and deal with anger later. Let everything fail and cause a depression. They chose the less damaging option. When banks were panicking, no one wanted to lend to anyone. So governments and central banks stepped in and said, "We will lend you money when no one else will." For example, the Federal Reserve flooded the system with emergency loans so banks could keep operating. Banks used this money to pay staff, keep ATMs working, settle daily payments. Without this, banks could fail overnight. Banks were also holding loans and products that were now worth much less. Government said, "We'll take some of these bad assets off your hands." This helped banks clean up their balance sheets. In the US, the government launched TARP, Troubled Asset Relief Program. It was worth about $700 billion. The government used it to buy bad assets, inject money into banks. This stopped banks from collapsing under losses. Some banks were so weak that loans alone were not enough. So government said, "We'll give you money, but in return, we own part of your bank." This strengthened banks and reassured the public. The US government invested directly in major banks under TARP. The UK government took ownership stakes in banks like Royal Bank of Scotland and Lloyds Banking Group. Taxpayers became temporary owners. Some institutions were so large that letting them collapse would have destroyed confidence everywhere. For example, AIG had insured huge amounts of risky loans. If AIG failed, many banks worldwide would fail too. The US government gave it over $180 billion in support. This wasn't about AIG alone. It was about stopping a chain reaction. Lastly, governments promised ordinary people, "Your money in the bank is safe." This stopped mass withdrawals. The US increased deposit protection via the FDIC. Many countries raised deposit guarantees to calm savers. If people had rushed to withdraw cash, even healthy banks would have failed. The lesson from 2008 is simple. If you mix easy money, hidden risk, and blind trust, the system looks strong, until it suddenly isn't. If you want more simple explainer videos like this, subscribe to our channel.